Well, hello, friend. Thank you for joining me in this little video today. I'm going to go ahead and talk about home buying. Really, I'm going to talk about home buying today. I'm going to be talking about some myths that are out there about home buying. I'm going to be talking about some mistakes that home buyers often make. And I'm going to be talking about some assumptions that I would never make if I were a home buyer. And I might tell a story or two as well. So, without further ado, I'm going to go ahead and just kind of start jumping into it. It's funny because just this morning I got a phone call from a somebody who's thinking about buying, and it was really great because he's got a home already, and they've kind of outgrown that home a little bit as they're kind of empty nesters. Their youngest is getting up there, and it's just three of them left in a fairly good sized home. And we just kind of started talking through things and he just said it just perfectly. Like he bought a house before, he's done that, but he didn't really feel like his realtor was representing him, and he didn't really feel like his lender really took the time to explain things. And of course, he said that because I had been explaining things to him, and it made him feel like he really understood what was going on. So anyway, that's kind of our style, and so that's what we're going to cover today is some of this stuff to help people kind of understand um, before it happens to them. So I've got my little notes. So if I'm looking down and reading, now you know why. If you're watching this, the long form video, I would suggest maybe throwing it in higher speed, just because when I'm talking, I don't tend to talk all that fast. And sometimes I tend to over explain things, maybe mansplain. I don't know if that's what it's called, but I do tend to go over things a bit. And so we'll clip this up and throw a few clips online. But for those listening to it now, there's going to be some pauses, so make sure maybe you have it in a higher speed. But myth number one. So, home buyer myth number one, you need 20% down to buy a home. That is a big fat myth. In fact, last time I saw there was a study I put up probably a couple years ago at this point, but it was something like 87% of non-homeowners, so renters, 87% thought they needed at least a 10% down payment. 87. That means almost one out of, or 9 out of 10 people that don't own a home thought they needed at least 10% down. Whew. Hey, let me explain what reality is. So if you remember, so I guess I'll just start with this. You don't need 20% down. Many buyers qualify with 3 or maybe 5% down or even 0% down. Some programs offer, and we have down payment assistance for a lot of folks as well. So let me go ahead and dive in a little bit deeper. So in the United States, there are five agencies, right? These five agencies you've probably heard of. FHA, they're the most popular one. Fannie Mae, Freddie Mac, these are two more. These are the conventional loans, if you've heard of those. Those are the big agencies there. And then sometimes people have heard that USDA and VA also have housing departments. And these five agencies represent 95% of all the loans done in the United States. So they're the ones actually making the rules, not the banks and credit unions that we're usually working with, even though they may have some of their own rules as well. But these five agencies are the ones buying these and insuring these loans from all the different banks and credit unions out there. So their rules are what matter. And so USDA and VA, they both have 100% down programs. They have no down payment requirement. So if you qualify for either of those programs, there is no down payment. So clearly not 20% down needed. And in fact, USDA, if you have 20% down, you can't get a USDA loan. Another one, so you got Fannie Mae and Freddie Mac. If you're a first-time home buyer, both of them have 3% down programs. And otherwise, it's 5% down is their minimum. And then, well, assuming there's one more affordable housing program that also offers 3% down. And then there's FHA, kind of the stalwart of the industry so many people have heard of, that's really friendly to credit and job history changes. FHA is a 3.5% down payment requirement. And like I said, with these three, we often have down payment assistance, different cities, different municipalities, different, um, what are we saying? Nonprofit organizations. Guys, you're listening to this video with me. Remember, if I've been doing this for over 20 years, that means I'm getting a little on the old side. So sometimes it takes me a second to think, what the heck am I trying to say? Anyway, so yeah, going back to this. So these three agencies that do these loans 3% and 3.5% down, they can often get down payment assistance from other entities like nonprofit companies. Just whoever's out there offering. There's more down payment assistance. That's a whole conversation all by itself. There's literally, I don't even know if there's a limitation. There's so many varieties out there, and I'll walk you through that if you need those. So 20% down is a myth. Okay, myth number two, renting is cheaper than buying. Okay, this one might actually be true, but let me walk you through an example. So this one I'm going to share my screen and I want you to see because this one is not that straightforward. So bam, 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 share my screen. I should be quiet when I do that so I can get rid of the silence, right? All right, so in theory, you can now see my screen that says year five at the top of it. And what this is a buy versus rent scenario that I have. So this is for a client actually who is paying 1,500 a month in rent for a one bedroom, one bath. And this is a house, not a condo, not a townhome. This is a house that they found in Salt Lake, and it is priced at 375,000. And this house is a two bedroom, one bath, and so it's a very tiny house, but it is a house with no HOA. And the total on this one, we're going with an FHA loan, so they'd have a 3.5% down payment, which their parents may gift to them, depending. Um, this is all an active scenario, guys. So isn't that cool? Isn't it cool and funner to look into somebody's actual scenario? So anyway, so yeah, this is still TBD, some of this stuff, but these are the numbers, okay? So right at the top, you can see this net gain by buying a home over 5 years is $35,000, we'll call it. But that's not what people are often paying attention to when they talk about needing to, that they can rent versus buy. So you'll see this year one shows a net loss of 67.57, and the year two a break even of 49 bucks. So basically it takes them 2 years to where this is actually even a good choice for them. And honestly, guys, I'm going to keep going through this, but honestly, that's one of the points that I wanted to make was if you're it's a myth that home buying costs more than renting. Kind of because if you go out 5 years, it's usually the first 5 years is the hardest time when somebody buys a home. And that was the case when I bought my first house over 20 years ago. If I told you the price, I've officially reached the age where I am now old enough that I'm the guy that tells people, I paid this much for my house. And everybody listening is like, no way, that was so cheap. I'll just tell you, my first house cost $169,500. Guys, that was so expensive when my wife and I bought that. I was panicking. That was so ridiculous. But that's what I mean, right? Your reaction was, "Oh my gosh, that was so cheap." Or you're my age and you're thinking, "I remember when homes were that." Yeah, notice the voice inflection when I said that. Anyway, so yeah, the first 5 years is usually the most challenging years for most home buyers. That's where you are house poor in most cases. I get some calls from people that say, I don't want to be house poor. And as much as that's a good thing, honestly, if you aren't house poor, you've probably waited too long to buy a house. There's a point. A house is not like any other thing to buy. It's not like a car. It's not like whatever vacations, right? You need to save up money for a lot of those things. But a house is going to increase in value over the long term. You're paying a loan down, so your equity is going to grow. There's tax benefit. It's just not simple. There's so much more that goes into it. And since it's increasing in value, it's often a lifesaver for so many folks down the road. Who was I just talking to Friday? Had a call with a past client that he bought 3.5 years ago. When he bought it, it was a 2-1 buy down, so he's able to get a reduction in his monthly payment, which I'm not showing here, by the way. But he had a lower monthly payment out of the gate, and the hope was that he would obviously have that lower monthly payment, but that rates would come down in the next few, months or year or so, so that he could refinance to a permanently lower interest rate. And he was excited about that. That was the point. That was what he was hoping for. But 3.5 years goes by before we actually finally reach that point. Um, and so my point to him though was because now we're refinancing and he's saving, I think it was $380 a month. He has a couple options where he can pay some points and actually get 400 plus dollar a month savings. But the reason that he's got so much benefit is because 3.5 years ago, he faced the music that nobody else wanted to face, right? Interest rates were high. And he was able to get his rate down to 6.5 at that point, but it was, that's coming to a broker who's got great interest rates and very aggressive pricing, and he was able to get a 6.5. Well, anyway, he's got all this equity now. He's been paying the loan down and his value's been going up and he's got all this equity. And so his monthly mortgage insurance is going to get reduced as well. Anyway, so that first 5 years is often where people struggle the most when they're homeowners. But if they can muscle it through the first 5 years, it usually gets pretty decent by that point. Okay, let me continue as I'm showing you this. So appreciation gain, this house, assuming a 4.4%, which by the way, guys, that is tiny. That is a low rate of appreciation, but that's where our market's been the last few years. If it goes up 4.4% a year for the next 5 years, that puts the new price from 375 today to 465,000. That's $90,000 of appreciation. You can spend that, guys. That's pretty awesome. Not till you sell the house or refinance it, but come on, that's value in your pocket. Amortization gain, that's loan balance repayment. He's going to have paid the loan down by $25,000 over 5 years. So there's another 25 grand home equity. But notice the cash flow difference. If he's paying 1,500 a month in rent, his monthly payment is going to be over 2,600 bucks a month. And that's over $1,000 increase in his monthly payment. That is where this myth comes from. A lot of people are like, oh, it's way more expensive to buy a house than it is to rent. Yeah, 1,100 bucks a month for him. And there's closing costs, but his seller's going to pay those closing costs. His income is not big enough that tax benefits really matter. He's already going to get the $32,000 standard deduction. And then cost to sell if he sold it, right? He would lose 18 grand now. If he's not selling it, that he didn't lose that yet. So coming down a little bit further, this is where I wanted to show you that cash flow. So it's 2,600 bucks a month, right? That's the first year's monthly payment versus 15. That's quite a bit of change. So this is the part that he has to figure out how to muscle through. But if he can muscle through that, look at what it does for him. 35,000 extra bucks in his net worth, really, unless he sells the house, then it's in his pocket in 5 years. So it is definitely better to buy versus rent, but it more than likely, at least in Utah, will change that cash flow. It'll be fairly stretchy. Okay, I'm going to stop sharing that screen and I'm going to come back to kind of my flow here. So renting is cheaper than buying. Myth. Some Utah renters are paying similar or higher monthly costs compared to owning. Um, overall, overall. Okay. Myth number 3. You need perfect credit to qualify. Uh, Not true. Obviously, we love perfect credit. That makes my job easier. I'm able to quote you better stuff, which means you like me better. So, true in that regard. However, we have FHA goes down to a 580 credit score. Now, 580, you know you have bad scores. In most cases, people with a 580 know they have bad scores. FHA goes down to 580 with a 3.5% down payment. FHA goes down to 500. 500 if you have 10% down payment. So if you're refinancing or you have a really good family equity position or something like that, you can have a 500 score and still get an FHA loan. I ain't gonna lie and try to tell you that a 500 score is awesome and that you're gonna love that loan or that loan closing process. It is hard for us to close that loan. They're very, very cautious because you have terrible credit, right? I mean, let's not mistake this. A 500 credit score is bleh, that's not very good. You know, you almost have to put effort to have a score that low. But some people run into some tough situations and they make some mistakes and they get backed into a corner or, divorces and things like that. They kind of wreck you sometimes. So you do not have to have perfect credit to buy. 580 or better, and 3.5% down payment's all that's required. So there you go. Myth. You do not need perfect credit to qualify. Okay, myth number four. You shouldn't buy when interest rates are high. You should not buy when interest rates are high. Myth. Remember the story I just mentioned a few minutes ago? The guy he bought when rates were 6.5, which that wasn't even that high. I've got another client that they bought, let's see, the recording of this video, they bought 9 months ago. Rates at that time, they got a 7.1 on a conventional loan. 7.1, I think most people would agree that's a fairly high rate. And they just refinanced down. We just closed them at 5 point, I think it was 8, 5.875. Um, yeah, they saved over 300 bucks a month. I think it was almost 400 bucks a month also. And obviously they loved it. That was 9 months later, guys. So they had to be brave enough and almost bold, right? To be able to step into the market when rates are at 7% plus and then turn around and be bold enough to buy. But guess what? They had great negotiations with their seller because the sellers needed to sell and that's what rates were at. And so they were able to negotiate a 2-1 buy down and they used those 2-1 buy downs to pay for this refinance, by the way. And guess who suggested they do that? All right. Okay, moving on. So you do not want to wait to buy a home. In fact, if you want to go to the best time in history, 2020 and 2021, as far as interest rates go, if you know anyone that bought during that time, ask them what their experience was like. It was horrible. You typically were writing offers on 20, 30, or 40 homes to get one accepted. Why? Because it was a feeding frenzy. Everybody and their dog was buying a house, and you'd put a for sale sign up in your yard. You didn't even have to put it online, and it'd be under contract that day. And they were writing over asking price offers and they would offer additional earnest money just for accepting the offer. Like that, you didn't even have to. It was a day, right? You accept my offer, you've got hard, non-refundable earnest money. And then oftentimes they were even offering over asking price appraisal gap guarantees. So if it doesn't appraise because I'm over offering what it's actually being listed at and worth, if it doesn't appraise, then I will bring 10, 20, 30, $50,000 to closing just to get to the 0 point of what it's actually appraised at. Guys, that was a crazy, crazy time. It was really hard on a lot of buyers. Are they glad they bought? Of course they're glad they bought, but a lot of them had to settle for homes they didn't really like. They had to do things that were really weird. So you shouldn't buy when interest rates are high. False. You should definitely not let that slow you down. Now, in 2007 and 8, the housing market was crashing, and we saw it crashing. And some people were thinking, man, I don't want to buy now because the house is going to be worth less in the future. That's still a concern I hear about today. That's not a valid concern today. Back then, was it a valid concern? Oh, yes, it definitely was. If you want more information on that, let me know. I'll be happy to dive in. That is not a valid concern. But if that were happening, should you wait to buy? Possibly. It depends. Even back then, we had a $7,000 and an $8,000 federal tax credit that was given to you if you bought a house in that market because they were trying to stimulate it. And if you're going to live there for 5 years at least, who cares if the house goes down in value next year? So what happened was in 2008, home prices were kind of going down. In 2011, 12, they bottomed out. And so by 2013, they started climbing again. And by 2015, I don't think there was a market in the US where home prices hadn't passed where they were in 2008. So there you go. You should not buy or you should not wait to buy just because interest rates are high. Okay. If you've heard any of these myths and you aren't sure what's true and what's not, it pays to reach out to somebody who knows. So feel free. I'm not some celebrity online. You'll see my number of views. It's not like I'm not some YouTube sensation. I'm not a celebrity. I just care about people and want to help people get their homes better financed in Utah. So feel free to message me, comment, reach out. We'll be happy to dive in deep with you. Um, the best way to know your options in any situation, in any scenario, is always to ask a lender. And as luck would have it, I happen to know a lender. I would be happy to hook you up. Yeah, that's me. I'm a lender. I've been a mortgage lender in Utah for 22 years. All right, let's talk about some mistakes. Mistakes that people make. Waiting too long to speak to a lender. Hint, hint. No, for real. This is actually a mistake a lot of home buyers make. They wait too long to talk to a lender. Some people go so far as to offer on a home before they talk to a lender. Why is that a mistake? That is a mistake because sometimes you don't know what your new house payment's going to be. And when you find out, you ain't going to be happy. So talk to a lender earlier for that reason. Why wouldn't you know? There's online calculators. Guys, those online calculators just aren't accurate. They can't know what situation you're doing. Even with all the AI we have and stuff now and the automated models, they leave so many landmines. It is so hard to automate the incredibly diverse loan options we have and mortgage insurance options unless you're kind of doing the whole scenario. And frankly, there's so many holes and landmines left by those AIs that we still are doing it all manually. We use the AI to help us in a lot of situations, but you need to talk to a lender. You need to get your monthly payment quotes accurate. You need to get your down payment option quotes accurate. You need to talk about your net proceeds if you're selling a house, and have those kind of at least semi-accurate. And then, yeah, maybe it's possible that we know something that you don't know, and maybe it's possible we'll actually teach that to you, and maybe that'll make an impact, a big impact on you. I don't know. Maybe. We'll see. All right, other mistakes home buyers make. Making large purchases before closing. Yeah, let's not do that. Large purchases would be like buying a car or going on big vacations and things like that, using up all that money. Um, and what I'm talking about is more after you're getting ready to close on a house. Still had people do that. Um, that's probably not my biggest concern. I have been doing this, like I said, over 2 decades, and I've almost never seen that. Most people seem like they're pretty smart. We do we do send out a lot of communication to our clients to make sure to encourage that they don't do that. But what I see a lot of home buyers make, especially first time buyers, is they get overzealous about paying off their debt first. And by doing that, they end up, um, well, how do I explain it? Our lenders don't need you to be debt free in order to give you a house. They're willing to lend you a certain amount of your income as a house payment, even if you have other debt above it. And if you have no other debt, they're still not going to extend that extra to you as a house payment. So a lot of people, they'll spend all their money on getting out of debt and then call me and they don't have a down payment. What I would suggest is that you actually, once you feel stable, once you have enough money to manage the bills, not to get out of debt, but to manage the bills for the foreseeable future, you definitely have enough of a cushion to manage those comfortably for a while. That's the moment that you want to talk to us. And when we go through the pre-approval with our clients, we're going to show you the what if scenarios. What if you pay this off? What if you do that? Here's the down payment requirements. What if you put it all here or put it all there? And we'll be able to go through that with you in depth. So that's what kind of comes to my mind. And that goes back to mistake number one, waiting too long to talk to a lender. But making large purchases before closing, that can be a deal breaker, honestly. Um, I had one so many years ago now. We just talked about this like last year too. He called me back and he needed new tires on his car mid-process and he was so tight. It was so hard for him to qualify to buy a house. But he did. He was able to successfully buy, but right at the last minute, I think he got a flat tire or something, and he needed new tires in a bad way. Guys, don't drive on unstable, unsafe tires. That's dangerous. Don't do that. Dangerous for you and others. So he went to, I think it was Les Schwab, and got himself a new set of tires, and that came up. We see that kind of stuff all the way up till closing. So we had to call and ask him, and guess what? He was so tight on his debt to income ratios that caused him to almost not qualify for a house. We solved it by calling up his homeowner's insurance and minimizing his coverages there. so that his premium went down enough to compensate for the debt going up there because he didn't have the money to pay it back. So we had to include that in his debt to income ratio. Phew, got pretty tight there. Okay, and talking about tight, mistake number three, buyers not understanding their true budget. For this one, I got a couple different things I'll say. So I kind of mentioned this earlier that that people are going to be house poor when they buy. If you're not going to be, you probably waited too long. You should hurry up and buy now. Um, I know that's a lifestyle choice for some folks. I just don't want to be house poor, but you're gonna be house poor eventually, or you're gonna wish that you had bought sooner eventually. You're gonna see the light. It's all gonna come together one day, and you're gonna be like, dang it. Um, so just remember that buy versus rent scenario I had up on the screen a few minutes ago. 35 grand over 5 years, and that's with the first 2 years being negative, right? If his rent was higher or he was able to somehow lower that payment a little bit more, like a 2-1 buy down or something, then that's going to be even better. But 35 grand over 5 years, that's kind of a big deal to be waiting too long. So that's one thing I would say is not understanding your true budget. Guys, I don't know. I mean, there's so many big voices out there that are saying this much of your income, that much of your income. I don't know that I buy into any of that because number one, everybody's situation is unique. So nobody over the airwaves should be telling you, including me, that it's this, that, or the other thing. I think that you might need a little bit of reality check before you pull the trigger. But if the bank can qualify you for it, more than likely you can manage it. You may need to grow a little, right? We all do. The other thing I will say in this is what if how do you what's a real live way of testing, right? So most people call me up their new house payment's going to be 2,500 minimum and probably 3,000 a month, 3,500 a month, not uncommon. A $600,000 house, probably 4,000 a month, right? So what if I'm only paying 2,000 a month in rent? How can I know that I'm going to be able to afford 3,000 a month? And so, a suggestion I've made to many folks, including my own family members over the years, is if that's you, then start paying the difference. So, if you're paying 2,000 a month in rent, start paying $1,000 to mom and dad or somebody else you know and trust that's going to give it back to you. But pay it out of your budget, right? Get it out of your control into somebody else's and feel that $3,000 payment. I don't think you need to do it that long, maybe 3 months, and you're going to have a really good idea as to what's like going to happen in real life. And you'll have 3,000 extra dollars saved up. So you'll have a little extra down payment, right? Not a bad thing. I think that's probably the best real world way of testing it. But before I go away from that, it's frequent that I have conversations with people where their rent is down and their new house payment's up here, and I'll ask them another question. How much are you paying towards your 401k? And that's usually a light bulb. Oh yeah, I'm contributing $200 a paycheck. Okay, well that's another $400 a month that you can turn off. You don't have to keep contributing to your 401k right after you buy a house. Guys, buying a house is comparable to investing in your 401k. I'd argue, quite frankly, it trumps it in a major way. Buying a house is a much bigger deal usually. Why do I say that? It's a little tangent here, but if you buy a $400,000 house and it goes up this year by 4%, which is a minimum amount of growth, that's $16,000. If you put $15,000 down, let's say it's 3% down, that's 12,000. 3.5% down, what is that, 13.5 or something like that? You haven't even put down the full amount that you're going to gain in appreciation year one, right? So you put down $15,000 or whatever, you get $16,000. That's more than 100% rate of return on that investment. Your 401k ain't going to give you 100% rate of return ever, right? So that's why I would say it's superior. So just kind of a couple ideas there to help people understand their true budget. Very long-winded version of that. But yeah, you're listening to me. Like I said, listen in fast pace. All right. Let's see. Final mistake that I see people trusting and knowing online information, including this video, right? I would like to either online or from friends, they hear something and they assume it's accurate. Guys, even if I tell you you should do this or whatever or that, and you count that, you always want to have the connection with the individual or people or entity or whatever that's going to give it to you before you count it as done. Because, right, that's why you get pre-approved with the lender, right? So that now you have the lender that's going to give it to you. So you don't just assume it's accurate. You've now validated it's accurate, or you validated that it doesn't work in your situation. You have to do something else. So be careful believing information online or from friends. Validate it. Find the individual or business that's going to give that information or give you that option. Now you know it's accurate. Okay. So, um, so if you're thinking about buying a home in Utah, message me. Let us help you out. Get pre-approved. Don't be afraid of the pre-approval. That's something I was about to talk about this actually. So I'm the one that should be afraid to talk to you about pre-approval. I'm the one that's going to be in your pre-approval when you go out the door and shopping has cost you zero other than some time. But for me, I'm in at 500 to $1,000 between the reports that I have to pull and the time that I have invested in it. 500 to $1,000 a client. So hopefully our clients stay with us because then we get paid when they close. We can reimburse all that, but you should not be afraid of getting pre-approved. So if you have questions about getting a home in Utah, a mortgage in Utah, reach out. Let us help you out. Also, you can follow us on social media, follow us here in this channel or the other channels and get more information on home buying tips and other how to finance this house. This is the biggest financial transaction in most people's lives. Get all the knowledge about it, get it all, capture it all, and have a strategy that's encompassing all of it. So, all right, I mentioned that I was going to talk about myths, mistakes, and assumptions that I would never make. So here's some assumptions I would never make. Um, I would never assume I don't qualify for a mortgage. Um, Always let the lender tell you no. And so if you need to pause the video and share this with this timestamp with a friend of yours, I hear this all the time that people tell me they don't qualify. And I ask them why. Did somebody pull your credit? Or did somebody look at your pay stubs or whatever? And they're like, no, but this is why I don't qualify. And I'm like, number one, I get paid to find a solution, a way to tell you yes. So I'm motivated to try to find a solution for you. So do not ever assume that you don't qualify. Let the lender be the one to tell you that. Okay. Whether it's down payment, credit, debt to income ratio, whatever. If you have a house and you want to keep it and then move into another one and you're not sure if you can, how do you manage both mortgages? We got solutions for that, guys. That's what we do. All right. I already talked about buying stuff before closing. So that's another assumption. Never buy stuff before closing, but it can impact your credit score, your debt to income ratio, your loan approval. Um, I would never change jobs before buying a house. There are many situations where changing jobs is just fine, but I would get pre-approved first and then walk through the scenario with the lender. And I do it first, not after, because sometimes people want to hang on to their jobs and then go buy their house and then go make those adjustments. They've got some great opportunity or whatever. Well, if it's a great opportunity, in most cases, it's still going to be there because they want you. So go get your house, get closed on it, and then take the opportunity. And then you don't have to worry about what we think, at least for a while. Um, I would never wait. So making the assumption that if I wait, it's better. There are only two reasons that I think people were waiting other than their own personal situation changes, which those sometimes they should just talk through with us. But interest rates will come down, home prices will come down. Guys, we are not in a market where home prices are coming down. If you think they are, text me, message me, comment, whatever. I will be happy to go through the details. It's not something I'm going to be combative with. I don't care. In some ways, I kind of wish they did, but other ways, I'm a homeowner several times over. I don't really want them to come down. That'd be in my best interest for them not to. But at the very same time, I would be interested in selling if they are going to go down. Yeah. I don't want to lose my equity and stuff. And I'm definitely not selling. I'm very interested in buying. So, um, interest rates, we already talked earlier. Buy now while the prices are where they are and refinance later when the rates come back down. Now, today rates are really, really good. So if you're buying today, you're probably not going to be doing any refinances, at least for a long time. We have to have something like 2020 or something like 2008 happen all over again to see lower rates again. And obviously, none of us want either of those. Um, I would never assume that renting is a better option. I would honestly, we should have me do a buy versus rent analysis like that. That's what I would do. So if you think your renting situation's better, let's plug in the numbers. Let's find out. Let's crack into it because it's so not straightforward. It's not just monthly payment versus monthly payment, as I showed you earlier. Um, I would never go home shopping before getting pre-approved. Mm. No, nope. Definitely would not. It's too much information you're going to get from the pre-approval. Besides, if I find a house I really want, the seller doesn't even want you walking into it until you've been pre-approved. And honestly, think about it. If they're living there, wife, kids, or whatever spouse, and they have dogs and all that, and you want to see it, they're going to bundle everybody up into the car, which how often do you take your dog in your car with you? But they're going to take their dog there, or cats, whoever. They're going to clean it really quick. They're going to turn all the lights on for you. They don't want to do that if you can't actually qualify. And how do you know if you can actually qualify if you haven't gotten pre-approved? I know lots of big, strong money earners with huge money in the bank that can't qualify or can't qualify for what they want. So getting pre-approved is easier than you think. Just reach out and we'll get you taken care of. It's 1 hour dedicated to getting pre-approved. If you're curious what you qualify for, that would be it. Now, one more thing I do want to cover before I wrap up this video is I want to cover just a quick little calculator. I mentioned how calculators online stink. This is not going to answer your question about what's my monthly payment. Um, but what this will do is give you at least a quick little rule of thumb if you're just trying to get a ballpark idea. How much can you qualify for? Well, my rule of thumb in this market with these interest rates is 5x. My income times 5 is the loan amount roughly that I'll qualify for, plus down payment. So if I'm going to put 100,000 down and I make 150,000 a year, that's going to be 850,000, right? So 150 times 5. And because I'm a mortgage guy, I can do that in my head just like that. So that's 750, and then I add $100,000 down payment, so that's 850. So I'd be able to buy an $850,000 house. But if I'm looking for an $850,000 house and that's my target, and I am barely lining those two numbers up, I would definitely get pre-approved before I went too far down that road. If I'm looking for a million, probably not going to make it. If I'm looking for 500,000, more than likely you're going to be just fine. So in a case like that, I would actually go ahead and you know, maybe wait until I was like serious, ready to go. Um, but yeah, that should be a good X. So just the 5X my income plus any down payment, that should put you there. So I think I've already said it many times. Follow us online for more information. Message us if you want to get pre-approved or have other questions in your scenario. But I'm not some fancy celebrity, so don't feel like you have to have everything just perfect to reach out. But it's just me. I'll respond eventually. I mean, it might take me a few hours to notice you've commented or whatever, but we'll get back with you for sure. And if not, then find me online, joshthomasmortgage.com. My cell phone's right there at the top of the page. Give me a call, shoot me a text. That I'll see much faster. So, other than that, thank you so much for joining me and spending your time with me. I hope I was able to keep you good company on your drive home or your workout at the gym. If you're still working out and I'm about to be done, throw on some Metallica or something. That really hits it for me. Or Three Doors Down. Good stuff. Or like my buddy from high school, he always used to listen to Enya. You out there, Scott? You watching this? Is Enya still treating you well? Man, I could never wrap my mind around that one in the gym. But yeah, whatever works for you. If my voice works for you, then come join us for another episode. You have a great afternoon. We'll talk to you then.